Welcome everyone to ACRES. We really appreciate your support. We definitely want to welcome our sponsors. Without you guys and your money, we wouldn't be here. So we really appreciate that. And in this event, I know I really appreciate the hard work Brad has done by bringing the panel, Susan, Greg, Brian, and Maggie together for this great event. So without further, I want to introduce Brad. I'm sure everyone knows Brad, so I don't need an introduction.
I think that's Sandra's way of saying I'm old, but thank you, Sandra. And I just want to thank the leadership of ACRE for putting this event together. Sandra, we appreciate your efforts and the invitation. Chris Gens is the current president, but is unable to join us today. Robin Reimhold is the vice president. And Matthew Butnick is leading us on our technology side today, and we very much appreciate it. When Sandra asked me to lead today's event, I had to think about what are we going to do that can really offer the audience some good information. And I thought that information from the street, rather than information from a bunch of talking heads that just are in the theoretical world, would be really valuable. And so one of the things, though, some people say, well, why would you ask your competitors, quote unquote, to do a panel with you? And I looked at it and I said, it took me a long time to realize this, throughout my career. But although we are competitors at times, we also play the exact same game. We're really like major league players, where some of us are in the American League West and others are in the National League East. We're all players. We compete a little bit, but we're also very complementary. We all have, look after each other. And I wanted to really offer the audience just tremendous experience of people that really know what's going on. In a year of surprises and contradictions and confusion, I think there's nothing better than just going to the experts. So I'm going to have each of the panelists introduce themselves. I'm going to start off, and you're all muted currently, but you want to make sure you take yourself off of mute after I call your name. And they're going to offer you a little bit of insight as to who they work with, what's their specialty, a little bit. And remember, I asked all of you to say something a little personal about yourself, something that maybe other people don't know. So Susan, why don't you start us off?
Sure, absolutely, Brad. Thank you again for the invitation to be on this panel. It's an honor. I'm with Western Retail Advisors. I'm a partner there, been there about 7 years now. We're a boutique tenant and landlord and investment sales firm based out of Arizona and Southern California. My specialty is really kind of on the tenant representation side, from kind of big box, junior anchor, pads, shop users, restaurants. We have a well-rounded book of business that really keeps us busy, kind of rolling tenants out the greater kind of 5 counties of LA. I'd say kind of a specialty would be crafting market entry strategies for new to market tenants to Southern California. And a little bit of context of just about my experience in the Inland Empire. We had the honor of bringing Five Below over to the West Coast back in 2016. They were nowhere west of Texas, and kind of since then, and focusing on kind of those 5 counties I mentioned, including the Inland Empire. We've done about 50 deals with them, and about 15 or so have been in the Inland Empire. We've got about 25 brands that we represent in Southern California, and about 15 or so that are pretty active in today's world, including a handful, 10 to 12 right now in the Inland Empire. So look forward to diving into that a little bit more. Something personal about myself. I'm actually not from Southern California. I've been out here for 11 years. I am from the East Coast, grew up in Marietta, Georgia, played college basketball for both Clemson University and the University of Florida. So go Tigers and go Gators.
Excellent. Thank you, Susan. All right. Brian, would you like to go next? You're on mute, the famous words.
Yeah. Hi, everybody. Sorry about that. I'm Brian Bielatowicz. I am with Lee and Associates out of the Marietta, Temecula Valley office. I have actually been with Lee and Associates since I started my career in 1999. And actually, Brad Umansky was one of the original OGs when I joined Lee. Well, I think we were one of 12 at the time, Brad. It was an interesting time back then. So yeah, I've been with Lee since 99, so this is my 22nd year. My specialty is mostly all facets of retail, but with a primary focus of landlord development, repositions, things of that nature as far as the sales and leasing side. Also work with quite a few tenants with rollouts, represent Verizon throughout California with Go Wireless, and several other tenants we rolled out like Popeyes into the San Diego market and other things of that nature. But basically my focus is purely, mostly landlord and development. So we've got, about 15 different projects right now, different stages of development, coming out of the ground, plan to come out of the ground in the next 24 to 36 months. So we're definitely seeing, the development activity ramp up as demand increases in certain market segments that we'll get into later. Something about me, I'm originally from Chicago. I joined the Navy back in 1995. Spent 4 years abroad, went around the world, spent about 3 years underway on the USS Nimitz aircraft carrier, landed in San Diego and basically never left. So call this home now. Been here half my life and actually been in the business half my life. Thank you, Brad.
Excellent. Thank you, Brian. And for anyone who's watching and thinking about getting into the brokerage business, you can already see that there is no typical path into brokerage. That's already been demonstrated by just our first two speakers. Maggie, would you please go next?
Sure. So I'm Maggie Montez, and I'm the owner of Lee and Associates here in Palm Desert. I've been in commercial real estate for more than 30 years. Seems like just a few minutes ago that we got started. We do everything Coachella Valley. We try to serve our business people out here, our tourists, but pretty good specialty in retail, ground up development. But we do a lot of office, and this past year we've done a whole lot of sales to our local attorneys, CPAs, of small office buildings with the good SBA financing. So anything that needs to be done between Palm Springs and Coachella, we've got a team that works on that. And I got into the business by being a secretary to the owner of a commercial real estate firm in northern New Jersey, just on the other side of the George Washington Bridge. It's a pretty interesting place to learn this business.
Outstanding. Thank you, Maggie. And Greg.
Thank you, Brad. Good morning. This is Greg Bedell with Progressive Real Estate Partners. I specialize in representing sellers of Inland Empire retail assets. A little bit of that's owner user, but it's really primarily investment sales, assets with a cap rate on them. Unlike Brian and Susan, I'm an Inland Empire guy born and bred, so I lack some of that diversity of knowledge in probably a negative way, but I also understand this marketplace very well. I'm from Riverside originally, went to Cal Poly Pomona, where I studied finance, and ultimately landed in Redlands, where I now live with my wife, our golden retriever Penny, and our 9-month-old Dean.
Fantastic. And once again, my name is Brad Umansky. I'm also with Progressive Real Estate Partners, and I have been in the industry for just shy of 30 years. All of my career has been focused on retail, all of it within the Inland Empire. Some of you I know that are on this call, and we have over 150 people on this call, have known me for a very long time. And so something personal that I would really like to share is that as of 3 days ago, my youngest daughter graduated from college. And so that means all three of my kids have now graduated from college. And in about 2 hours, my wife, daughter, and I are going to hop in the car together, and we're going to drive up to Olympia, Washington, where my youngest daughter starts her new job in about 5 days. And so 3 kids graduated from college, 3 kids employed, 3 kids paying taxes. I feel like a little mic drop moment right now. So there's a ton of people that have been involved in helping me get to this point, and I just am so grateful for all of that. But let's kick off. Let's get going here. Maggie, tell us what was your expectation of what would happen in the Coachella Valley relative to COVID, and then what did you actually observe?
Yeah, boy, their world's different. So probably last April, I was sitting at home wondering if I was retired and just didn't know it. Everything had gone to hell in a handbasket, and all the deals had just stopped. We were all so frozen with fear and the unknown. And when it became clear that this wasn't going to go away in a couple of weeks, and it was just so much unknown. And then in May, the phone started ringing again. And by summer, my associate Shauna, who's worked with me for 16 years, we were busy. And we are usually really busy during the summer months because a lot of people want to do leases then and get in and going for the fall, right? They want to be open in, let's say, October, November. So that's typically a busy time of year, but we had no expectation of it being busy at all. As I said, then the sales started really picking up of the existing buildings with the great SBA financing. And then we've just seen certain sectors fill in. El Paseo, which has really struggled for the last 10 years or more since 2008 recession, is getting kind of eaten up by different furniture line stores that are moving in. And they're taking for what for us is big spaces, 4,000 square feet, 6,000 square feet. And so that's been a phenomenon I wouldn't even have guessed was going to happen. We've also seen tourism go through the roof out here. So luckily, after a pretty disastrous year, a lot of our restaurants and businesses are just saying that things are looking good. And we think that people will continue to come here. I think there's still a lot of people hesitating about getting on planes and going away. So it's turned out so much better than I had thought at this time last year.
That's great info. And Brian, what have you observed?
I would say fairly similar. Obviously when the lights went off in March, everybody was scrambling to figure out what to do and getting on Zoom calls, asking the guy next to him, what do you think? So that was a very interesting time. I don't think I've ever seen that in our industry where everybody kind of had a big blank on their face. So as we recovered through that, I mean, I'd say our volume did shift a little bit to more of a slow pattern. A few deals to go sideways, but I'd say that in general, a lot of our deals, stayed in place. We added, some workouts and some provisions for, rent abatement based on closures and things of that nature. But generally, we started, continuing the volume, and the volume started picking up, in summertime, like Maggie was saying, with a lot of, different uses. I would say uses that aren't the most desirable, such as like smoke shops and liquor stores and things of that nature, thinking there was blood in the water when I think everybody was trying to hold the line. At least I was, as far as not dropping rents, not showing that there was blood in the water. So we held the line, and I think we're still seeing that segment still pretty active, searching for space. But generally speaking, we've seen a lot of different new concepts starting to pop up in our market and searching for space, which has been great. But generally, Temecula, Murrieta, the whole valley is fared, fairly well. Very little vacancy, stemmed from the pandemic. A lot of landlords did a lot of workouts, deferrals, and things of that nature to keep it, keep the boat afloat. And the blood was not in the water whatsoever. And we've been very successful in this past year. We've executed close to 250,000 square feet of anchor deals, with Floor and Decor. We just opened earlier this year. Burlington, we did a relocation within the center as well. We also did an at-home deal in Temecula on 86,000 feet. They'll be opening at the end of June. So just to name a few, we have several grocery store ground-up developments in play right now. So the activity level has not really stemmed off too much, especially in development. I think a lot of stuff with runway, a lot of time in front of it. A lot of people were willing to work on that during the pandemic, and the ones that were are kind of coming out ready with some product to feed the current demand, which is drive-through. So I think we're seeing a lot of that shift in development, how we're designing site plans, how we're designing our projects to feed that demand. So that flux and change is, happening currently, and I think we'll start seeing a lot of different types of projects coming to market here in the next 2 to 5 years based on this pandemic.
Great. Brian brings up a great point for, going into the pandemic, vacancy rate in the Inland Empire was 6.8%. It then, in a very short period of time, kind of spiked to 8.1%. It actually got as high as 8.2% as in February of this year. So just about 4 months ago. And it's gone from 8.2% to 7.6% in just about 3 or 4 months. And I think that's very reflective of what Brian was just saying relative to some good absorption of some big spaces. I know our office was involved in a Burlington, a Grocery Outlet, a Big Lots deal that also probably were a part of some of those numbers. And I think we've seen a lot of good absorption. And what's interesting is that a lot of that happened without fitness clubs, which really were one of the leading absorbers, leading tenants to absorb space over the course of this past couple of years. Greg, I'd love for you to speak from the investment sales perspective. What did you see kind of over the course of this past 12 months, and maybe what are you still seeing relative to the multi-tenant and single-tenant investment sales market out here?
Yeah, sure thing. If we were moving on the freeway at 60 miles an hour in February of 2020, we were going 5 miles an hour in March and April. By about I'd say August, September, November, it kind of started to feel like we were getting back up to 30, 40 miles an hour. And now it really feels like we're getting back up to those sort of freeway speeds. Investment sales volumes were down 52% last year. No properties over $10 million sold, with the exception of a couple car dealerships that I've really kind of carved out as outliers. 54 assets over $1 million sold, of which about 80% of those were single tenant assets and the other 20% were multi-tenant. So we really saw a massive downshift in multi-tenant activity and a focus on what I would call a perceived flight to quality on some of these single tenant assets. And interestingly enough, and Brad wrote a blog about this, we saw the average cap rate drop in the Inland Empire, and we saw the average price per square foot go up. And from 10,000 feet up, it may seem like the investment sales market was performing very strongly, but in reality, it just wasn't. We were seeing that the assets that were trading were single tenant assets with higher rents and therefore a higher price per square foot that were trading at lower cap rates. And because multi-tenant was removed from the equation, the averages were skewed quite a bit. You fast forward to today, we're seeing a lot more multi-tenant come back online. We are certainly seeing more interest in it as financing becomes more available, as it becomes clear which assets performed well and did not perform well throughout the pandemic. Assets, in my opinion, that performed well during the pandemic were really a proof of concept of resiliency for a center. If you have a center that's in a core area on a good intersection with a good rent roll and its tenants performed well despite a pandemic, granted, you may have a handful, you may have a nail salon, a hair salon that really there was no way to perform well. But outside of those, if they did, you're starting to see those centers come back online and interest in them. We just took a center in Colton out to market last week, about a $9 million shopping center that we really were holding off on taking out to market until the timing felt right. And about a month ago, we decided the timing felt right because financing returned. Investors can get debt on this asset in the high threes, with even some interest only in the beginning there, depending upon the lender. This is a center where most of the tenants performed very well, not just during the pandemic, but a lot of these tenants were there during the 2008 recession and performed well then. And investors are looking at assets like this, where the tenant mix is service oriented, where they performed well, where it's in a core market, where they can get really attractive debt and therefore cash flow very well, and are starting to see the opportunity there because assets like that were really tough to come by a few years ago, and so they're starting to come back online. So that's sort of the 12-month arc, Brad, to answer your question of where we're at.
Yeah, I think for the first time in 12 months, people can answer the question of who's paying rent and who isn't, and who's likely to survive and who isn't. Versus 6 months ago, nobody had any idea what a rent roll was. Just an imaginary piece of paper 6 months ago. Not understanding how it really was going to play out. So Susan, and one of the reasons why we invited Susan to be on the panel, because Susan drives this market probably more so than any of us, because she's got to work the entire region versus most of us work more of a specific area. And so, Susan, I would love to hear from you. How have the retailers perceived this market over the course of the last 12 months? How did COVID affect some of the expansion of some of those retailers? And then did some of those retailers, did they think that they were going to get, some great bargains that either have or haven't played out? Share with us what you've learned.
Yeah, sure, absolutely. So, I was fortunate enough to have a handful of tenants that relatively low impact on the COVID pandemic. Some examples, PetSmart, right? Like the COVID puppy trends. And they're being really well positioned with their acquisition of Chewy.com several years ago, really had them set up for going online. Five Below, a discount retailer that really can thrive in any market. Mattress Firm, who, like everybody else has said so far, last summer, the lights just came back on and the sales lifted from everybody staying home and wanting to upgrade their mattress and, their home furnishings. Boredom Brew was another one, opened up their very first Inland Empire location in the heart of the COVID summer last year, and is already looking for their second location, that operator, because he was able to pivot, that whole chain was able to pivot and do the to-go thing. So thankfully, I saw kind of the demand in the Inland Empire grow. At least 2 or 3 of those guys that I mentioned did not have the Inland Empire on their radar at this, in the last kind of previous 12 months. Mattress Firm now seeing, who's well covered out there, now seeing this sales picked up, let's squeeze in another store in between. We got that feedback throughout the last 8 months. Same with PetSmart, who wasn't super active 12 months prior. We've now got several deals going on out there. So it's been a wild ride of kind of those, like everybody said, first 2 months, lights were off, and then kind of late summer, everything picked back up. I agree with Brian in the sense that those new construction centers never really stopped coming online out in the Inland Empire, and that fed the demand for these tenants that were out there looking. Whether that's, the PetSmarts or the grocery anchors or, the pad guys, that's been huge to see. I mean, the fact that the new construction, I would even say that the activity on those new construction centers actually picked up if you talk to some of those landlords and those landlord brokers. So yes, everybody was out there in the beginning kind of shopping for a deal, no doubt, but in those A+ centers out there, the rents really didn't squeeze. If anything, maybe some more tenant concessions and a little bit of kind of leeway in those first couple months. But everybody out there shopping for a deal kind of found out later last year and earlier this year that those days, it never really materialized across kind of the A+ and the A+ stuff, the A and the A+ stuff out there, even B+.
Great feedback. We do have some questions coming in. I will I'm going to continue on with some of the questions for the panelists, but then we'll probably take a few minutes to answer some of those questions, and then we'll keep going. I would, Brian and Maggie, you guys have been working this market for at least a couple of years. I'm just curious, have you guys seen, is there a difference that you perceive in terms of, is there a difference that you think your clients and your tenants and everybody perceives of your market today compared to maybe 20 years ago? And I'll ask Brian to start off. How do people perceive South Riverside County today compared to back then?
Yeah, so when I first started in Temecula, I was back in '99, there was 50,000 people between Temecula and Murrieta, and about 100,000 in the valley. So when I would call tenants and cold call, they would be like, Temecula, what? Who? What? It's like, well, where are you? Like, are you even in California? Right. So that was kind of like the initial feedback we would get. So it was interesting times back then, but flash forward 20 years later, between Temecula and Murrieta, you've got over 230,000 people, just within the two cities. And then, if you pull out our trade area, we're well over 830,000 people within about a 20-minute drive from Temecula, which is about a little over a 10-mile radius. So significant growth has taken place. Some of the hot spots right now are like French Valley. There's over almost 20,000 units in some phase of development within the French Valley region, which is northeast Murrieta, and then north of Temecula, east of Menifee. And Menifee is also another huge growth market. We've got over 15,000 homes in some phase of development right now. But there's over 156 tentative track maps with 23 specific plans, representing 46,000 new homes within about a 15-mile radius of Menifee. So the market has just been driving by the growth, and the growth is coming from suburban families. It's a very young demographic, and they're really enjoying the amenities now that Temecula has grown into, such as the Pechanga Casino. They did a $300 million expansion. It's one of California's only first-class casinos. It draws headliners, like all different types of events and whatnot. And we also have our wine country with over 40 different wineries. And it's really become a travel destination. We've got over $1 billion in annual travel, in annual spending within our valley, and 9,000 tourist-related jobs, $3.1 million, 3.1 million visitors annually. It's been pretty extensive what I've seen over the last 22 years and what's happened out here. And that's what's driving, this growth and this trade area's success and very low vacancy.
It really is amazing. I mean, there are communities, and there's the amount of infrastructure that's continuing to be built. If you drive the 15 freeway or the 10 freeway right now, it's just amazing to see what's happening with some kind of the infrastructure. And Menifee is a community that I kept hearing about. I kept hearing the name, and even though I'm out here, I'm like, what's a Menifee? And Eastvale was the same way. Like, what's in Eastvale? And then all of a sudden, you start driving these markets. Like, where did all of these houses come from? Where did all of these beautiful retail centers come from? It's really remarkable how you can blink sometimes. And I mean, it's not quite a blink. This has happened over 5 or 10 years, but there are these communities that all of a sudden experience explosive growth. And so that's part of why I wanted to include this on the panel, because I wanted people to be able to hear about some of this. Maggie, how about your perspective? What is the Coachella Valley today compared to, let's say, 20 years ago? What does the world think of relative to the valley?
Well, I think, so 20 years ago, I once heard this description of Palm Springs, that it's for gays, grays, and streets named after dead people. And I always thought that, that's pretty accurate. And so we do certainly have a population that's geared a little bit older and the retirement, but we've really seen the pickup in the homes. And obviously with this COVID residential boom, we are experiencing it. I mean, honestly, the home prices in my small neighborhood have tripled, and people are just buying all cash. And these are mostly younger people with young children. So they're the shoppers. We always lag, I think, about 12 months behind the gist of Riverside. I think that there's still a lot of retailers that aren't sure whether they need to have a store in the Coachella Valley. And luckily for me, I've represented Desert Crossing, where I did a deal with Susan for Five Below, which has Target and Bed Bath & Beyond and DSW shoes. And it's sort of been that the retailers, if they were going to come to the desert, they wanted to come to that intersection, Highway 111 and Fred Waring Drive in Palm Desert. And what they found is those sales were strong enough that then it was time to do something in La Quinta and do something in Palm Springs. So we too have grown. I mean, we're now up over a full-time population of about 425,000 people, growing very quickly. New units are selling like hotcakes, and the builders can't get the product out there fast enough. They're just releasing it in small blocks so they can take the price up each time. And I just hear that there's bidding wars going on all the new projects.
Great. Hey, I want to hit some of the questions. Maggie, one of the questions was about, can you speak at all relative to this proposed $250 million Coachella Valley Arena at I-10 in Cook? Do you know anything about that?
I do. I know quite a bit about it. So the Berger Foundation is a very philanthropic group out here, and they're working with Oakview, and they've broken ground, and all of the plans are approved for an 11,000 seat arena. We'll have an American Hockey League there. That'll be their home court, but we will have shows and all kinds of entertainment. It was originally planned to be done in downtown Palm Springs on the Agua Caliente land by their casino, which is really at Indian and Tahquitz. There was a lot of concern, which finally I think everybody looked at, like, how logistically do we get that many people in and out on these Palm Springs 2-lane roads? And so the Berger Foundation had land up by their Classic Club. They built a golf course up there that was part of the PGA Tour for many years. Had the land and said, come on down here. So they are right at the intersection of I-10 and Cook Street. And I think most people are pretty excited about it. City of Palm Desert is a little concerned that some services are going to fall on them while the arena actually sits in the Riverside County. But I think those things are getting worked through.
Great. And do you think, what do you think that will do relative to the land around it in terms of potential retail opportunities?
Well, yeah, we represent an organization that owns a retail center at Cook and Gerald Ford, and they had approvals for a 9,000 square foot restaurant. And we said, just hold, don't build, because somebody's going to want it to their specs. So we really do expect that is going to feed, especially those hotels and restaurants that are already on the Cook Street corridor. And there's room for growth there. We've also got land with our university, and there's a big push in that same area to bring a full-time four-year college, UC campus.
A UC campus coming to the desert, huh?
Well, they're trying.
Great. I'm just looking at some of the other, some of the questions are questions and some of them are comments, but can you talk a little bit about, I'm gonna start off with Susan relative to her perception. And I think, Susan, pretty much all of the retailers that you're representing are looking for kind of more the Class A type center. Is that, do you have anybody who's looking at the kind of the older centers, or is it for the most part they're looking for the high quality? Yeah, it's the high quality center. What have you seen relative to lease rates and triple net charges in those centers over the course of the last couple of years?
Sure. So, it's been interesting on the new construction stuff, and not to kind of harp on COVID, but COVID didn't allow for any real concessions on new construction stuff because it's so far out in advance. No one's feeling sorry for, a 2022 deal or, 2023 deal. So we saw rates, just new nodes, like new shopping center nodes that are being created around this growth, rents being in the $48 to $60 range for, pad users and, kind of prime shop space. So that's kind of on the new construction side. Some of my clients were surprised at some of the sites that I was sending over to them and the Inland Empire rents I was quoting them. As far as the existing stuff, like I said, A+ and A, the vacancies, very little change. It continues just to kind of get more competitive out there. And I think, it did allow, COVID kind of did allow for, maybe the mattress firms or the less, the more service tenants to have a chance on some of the more, A+ stuff, because some of the restaurants had died down a little bit. And so everybody was restaurant, on the landlord side. That's what they wanted to see. This allowed some of those kind of non-restaurant guys to get a little bit more competitive, but they're still paying, I'm not doing many deals south of, 40, the 40s out in the Inland Empire on the shop space stuff. And then triple nets, tenants are getting more and more, eagle eyes on what they're paying in triple nets, because it's all a gross number to them at the end of the day. You can chop it up, base rent or triple nets, but at the end of the day, what's that gross number going to be? And they're paying more attention to that CAM, tax, insurance breakdown. What are they paying in management fees? Is the landlord double dipping on the on the management and the admin fees? Because it all these guys have to go to their committees and explain that. And so I get a lot of, why this center is 30, 40 years old in the Inland Empire. Why are triple nets north of $8, and stuff like that. So continuously seeing kind of triple nets creep, and, that has to come out somewhere. on the base rent number, usually at the end of the day. But hopefully that answers your questions. That's kind of what I'm seeing out in the Inland Empire.
It does, and just for clarification purposes, Susan deals with national retailers, and so she's used to quoting things in annual rents. So
Yes,
recognize that those are annual numbers, not monthly numbers. I just want to follow up. What about the anchor, the spaces that the PetSmarts and the Five Belows are looking at? What kind of, if you had a broad brush rents that you're seeing quoted on those spaces,
Yep.
what would you say you're seeing?
Sure, absolutely. I'd say anywhere from the mid-teens to the low 20s. PetSmart needs turnkeys. Five Below usually is pushing for their turnkey, so you have to build in, maybe I'm seeing, low 20s, low to mid 20s on kind of the upper echelon markets in the Inland Empire for a turnkey PetSmart deal. And then PetSmart's or Five Below is pretty consistent, kind of that high teen, very low 20 deal. If it's new construction, obviously kind of in that low, $20 to $22 range is what I'm seeing. So yeah.
And when you're saying turnkey, and I know you've recently been involved in taking a Pier 1 space, I think Five Below taking a Pier 1 space. What do you guesstimate it's costing to go from a Pier 1 to a Five Below in terms of a TI allowance?
Yeah, no, that's a good point. So, I mean, Five Below is really not taking anything south of 50, 60 bucks a foot right now if they're having to convert kind of a G stage or a Pier 1 or, kind of an existing kind of shell. So, it's expensive, and PetSmart probably even a little bit more than that if they were to have to take it as is.
Great, thanks. I think that, and Brian and Maggie, I'll go to you, but I'll just put in my 2 cents. I've clearly observed that the national tenants, that the TI allowances that they are asking for, and in many cases demanding, because they're basically saying, if you can't do it, we'll pass and we'll just do a deal someplace else, are quite significant. It's costing a lot of money to re-tenant spaces. And Brian, maybe you could speak, because I know you mentioned some of those anchor deals.
Yeah.
What are you seeing? What did you see in some of those anchor deals?
Yeah, and they're definitely driving. It's a mixed bag. I mean, you've got tenants like PetSmart, right, that drive the turnkey, and same thing with Five Below, and then you got Burlington, who does the same thing. Done a couple of those deals recently, and they drive, turnkey shell, and it's coming up about 65 bucks on the interior build, and it also depends on what the facade looks like. Like on one project in Marietta, we're doing a complete redevelopment of the project where we did the floor decor and a Burlington, and we did new facades. So there's obviously sunk costs on exterior remodel and such that could go into that. But generally speaking, we also did a grocery deal that was very expensive. We took an old Rite Aid, kicked down a wall, knocked down some shops adjacent, added on to a Rite Aid that was 19, that is now 35,000 feet to accommodate. We put $4 million into the deal to make it, but the rents were, in the low 20s. So a very strong, economic deal for the landlord and what the tenant brings to the project. But we are definitely seeing ITA requests, more, turnkey build to suits. Even on the restaurant side, we're not shy. We're coming in asking for 75 to 100 bucks a foot on bushfire kitchen deals. We've got a very expensive build out, and we're actually getting that, believe it or not. But we are paying for it in the rent. Same thing with other Burlington deals. They do recognize the cost, and they do, push a little bit more to get a higher rent than they would normally pay, at least historically. But then, like for floor and decor, that was more of an easier deal, actually. So we actually, we didn't do that. They took over the facade work. We moved the demising wall, and we gave them, in that range of 20, 25 bucks a square foot of TA, and they did all the work. So, apples and oranges compared to the grocer that we did in the same project compared to that. And, with At Home, that was another as-is, delivery deal with a capped TI allowance, where they did all the work. So another example of how it could go versus a Burlington deal or, a LA Fitness deal, which now, from a ground up standpoint, they look for, 180 bucks a foot as a reverse build to suit contribution, plus a, fully improved pad with all on-sites, off-sites done. So you can imagine those rents are going to be in the high 20s, if you run your pro forma. So it's really all over the board. Shop rents in Inland Empire, focusing more on Southwest Riverside County, are probably some of the highest in the Inland Empire. Finalizing a deal right now at $66 annually on an end cap shop space in one of my centers. That's unheard of in this market. With a triple net, that's $13. So it's a big
drive-through or no drive-through?
no drive-through.
No drive-through.
No drive-through. So, and then some on a drive-through deals, I've got a few ground right now that we have signed leases on, or in leases at $100 a foot annually on rent. So
so on the flip side, do you have spaces that are in B and C centers where the rents that the tenants are paying today are also the same as they were 15 or 20 years ago?
The BCs have, kind of come down over COVID, absolutely, because it's not as desirable, and you're dealing with uses that are not as desirable too. So BC is definitely struggling, the A minus, B plus, we've held the line. We've actually gone up in rents, based on our lack of availability. But the BC definitely is struggling. And, from a standpoint of triple nets, the trend is ever gradually increasing. As Greg sells all these properties, we're seeing new tax bases come in and just really jacking up triple nets. I mean, I've got some properties that are $16 on triple nets, so $1.30, $1.25, $1.35 a square foot. It's hard because these landlords got to understand that that affects how we can perform for you. If you don't take the bull by the horns and actually look at your tax base, hire a consultant, go do an appeal, you're going to help us improve your NOI, your value, which plays in the value of your center to create more rental income. And Susan can probably attest to that as well. She could probably pay more rent because a lot of these tenants look at it from a gross occupancy standpoint. So, I've definitely been pushing my clients to hire consultants or whatnot to focus on bringing their triple nets down so we can help the valuation of the properties long term.
Great feedback. Maggie, the Coachella Valley is product that is 40, 50 years old or older, as well as product that's brand new. What are you seeing across the market from a B and C type rent and compared to A? What are your observations?
Yeah, so in the older shopping centers, we're anywhere from $1.50 to $2 a square foot, but those triple nets are tending to be closer to that 50-60 cents a square foot number. Same as just what you're hearing from everybody else. We've got some new construction. We're under construction at I-10 in Monterey with Fountainhead Development, and the shops are running $48 a square foot. The triple nets are a little bit over 12, and even on the shops, we're looking at tenant improvement allowances of about $30 to $35 a square foot.
Yeah. Are you finding it's more difficult to lease the second generation space in the older centers compared to the newer centers?
No, we're really not. There still are enough uses. I think sometimes some of those older centers were built with so much shop space that you start to have repetitiveness. And that's one of the things that's tougher to do. I just don't think anybody who was building today would build nearly as much shop space as they used to, where they just squeezed as much as they could onto any site. So I think that's our biggest challenge with the older centers. But as Brian mentioned, some of them are the not so exciting uses.
Great. Hey, Greg, can you speak to the similar idea amongst, if you're selling the property that was built in the last couple of years, that's, nice and pretty with a good quality tenant mix compared to selling the center that's 30 years old with mostly mom and pops? What are you seeing as the perceptions of investors? And then also you might want to even add on geography, whether that center is in one type of a trade area versus a different type of a trade area.
Yeah, and earlier I mentioned the phrase perceived flight to quality, and I said that because there is a perception that newer construction assets with national tenants or tenants are even just perceived as a brand that's recognized, there is a flight to those assets, and sometimes the retail fundamentals really don't line up. You have assets with new construction rents with triple nets that are going to go way up. I was just messaging with Brian to tell him that we're working on an asset now where the triple nets will jump to $1.89 per square foot post sale. And while Starbucks, one of the tenants there, can eat it and will eat it per their lease, we have other tenants there that while they're brand name, it's going to be a tougher time. And and these are assets that sometimes it transcends location. If it's new construction and it has these tenants, if it's in a part of our market that would traditionally be viewed negatively, whether it's and negatively is the wrong word, but maybe not as positively as more core areas on the tertiary end of the spectrum, there is a flight to those versus you have multi-tenant shopping centers with mom and pop tenants who paid their rent during COVID, who are paying low rents, whose triple nets are low, who have been there forever. And so your downside is really limited in a lot of ways, but investors with a lack of that understanding of those fundamentals will overlook those assets oftentimes and move towards sort of what I will deem sort of the shiny object of new construction. And so we're certainly seeing that on an age or of a product type, and then geographically, very similar. It's interesting, over the past few weeks, I've had several discussions with folks who will look at an asset and they'll look at the city it's in, and they sort of have a predetermined opinion of that particular city. And they're not looking at what intersection this asset's on. They're not looking at the strength of the intersection or the strength of the corridor. They're just looking at, that property's in San Bernardino. And it may be an A+ intersection in the city of San Bernardino with a lot going for it, but that individual may rather buy something on a C intersection or even off corner in let's say Rancho Cucamonga or Riverside because they have a different perception of the city. So we're constantly battling these sort of preconceived notions of certain parts of our marketplace. And oftentimes it's from folks who very rarely travel east of the 405, and that's fine, but we're very, very far from the 405 freeway. And so, while I like to say Rancho Cucamonga is East Hollywood, I say that in jest, just not true. You gotta drive out here and really drive the centers. Look at the intersection it's on. Don't look at the city. Don't look at the age. Go drive the center and stand in the parking lot, because it's the age of Google Maps is really taking a lot of gut feeling out of the business. And so get out there and drive.
One of the best stories in our office is when Greg was presenting a property in Paris, and he referred to it as infill. I think it was infill Inland Empire, and we all kind of found that to be quite entertaining. That then he started to explain to us that it's surrounded by industrial buildings. There's almost no land available around it, and that's why it's an infill site. So we are seeing more and more sites that used to be considered more on the secondary or tertiary environments that are becoming more infill based upon all the development that's occurred around them. Brian, you wanted to talk about kind of these landlords that are doing some fixed cam type transactions, and I think that's a great topic.
Yeah, it's a trend that I'm starting to see. I handle a lot of all the Kimco stuff, Regency, whatnot, in our market, and these institutional landlords are starting to implement a fixed cam, and that fixed cam would be somewhere in the 3-4% range is usually what they ask. They might negotiate down to 2%, but it's kind of flipping it on the tenant, where the tenant would come in and ask for cam caps, and the idea behind it is management of cam and trying to figure out a way and a solution where tenants aren't getting hit with cam reconciliation bills 2 years later, things of that nature. So it's a much easier way for these landlords to manage their cam. But it is definitely something new. Tenants are like, Susan, I'd love to hear your perception on fixed cam, but I'm definitely seeing that implementing that more in our deals. It's been accepted 9 times out of 10. I haven't really lost a deal out of it, I think, but it's definitely something new, and it takes that leverage away from the tenant to negotiate on their cam cap. How are you perceiving that, Susan?
Yeah, absolutely, Brian. I totally agree. I've seen it more in the last year than I have ever in my career. These national guys, it's a couple of different things. One, just portfolio management, right? You've got 500 to 2,500 stores. if you take the guesswork out of budgeting what the CAM's going to be in 5 years, they're usually all for it. I'm seeing landlords push more for the cumulative cap, which is bringing up the conversation for the fixed CAMs. And I've got at least 2 or 3 of my national guys that are totally fine with it. It's like, it's almost the same conversation every time. Non-cumulative, cumulative, okay, and then we end up on the fixed CAM in that 3-4% range. I'm not seeing too many 5%. That's a little bit out of their comfort zone. But kind of the 2, 3, 4%, I'm definitely having more deals land on the fixed CAM side for sure.
And just for clarification, when we're talking about CAM, we're not including taxes and insurance in that discussion. It's true common area costs. And one of the things, you know, so long as there's an opportunity to reset at the end of any particular term, it makes a lot of sense from a landlord's perspective. It takes away the effort of doing CAM reconciliations and then having to fight with the tenant on collecting it. It really, and from the tenant's perspective, it takes away the ability, you know, they're having to have the expense of an accounting department. And so it definitely has a lot of potential. If you believe that we're going to continue with low inflationary times relative to the costs that are involved in common area maintenance, then it has potential. If you're concerned that we're going to have very high inflationary times, then it can be very, very concerning. We only have a couple of minutes left. I did want to just make sure. I know, Brian, you alluded to a lot of the great things that are happening down in the kind of the South Riverside County area. Greg, would you, I know, Greg, you had prepared some items to kind of just share with people, maybe some things that they weren't aware of that are occurring in kind of more the Western Inland Empire, San Bernardino County area. And then Maggie, I'll go to you. If you could just kind of share some information, that'd be great. Greg.
Yeah, and I'll just kind of rattle some off quickly so we can get to Maggie, but I'll start with infrastructure. 5 years ago, we had no fast track lanes in the Inland Empire. Caltrans has now extended the 91 freeway fast track lanes from Green River in West Corona out to McKinley in East Corona. They just completed work on the 15 freeway fast track lanes from South Corona up to Ontario. And they started construction on the fast track lanes on the 10 freeway, which will go from the LA County line out to the 15 freeway and eventually out to Redlands. They widened the 15 freeway up to Victorville to add a dedicated truck lane in anticipation of more industrial going in and up in the high desert regions. San Manuel, just as Brian mentioned, one of the casinos down his market, San Manuel just completed or is currently under construction, soon to be completed, a $550 million expansion of their hotel and casino with a new pool, fitness center, spa. It's about 750,000 square foot total between the hotel and other uses there. Just down the way from them at the San Bernardino Airport, they just completed a $200 million expansion that adds a dedicated Amazon fulfillment center and distribution center on site at the San Bernardino International Airport. 4,000 new jobs there. Top Golf is going into Ontario. I believe this is either their second or third location in Southern California after San Pedro or El Segundo in LA. Now they're coming just north of the Ontario Airport. And one of the more interesting ones, the Boring Company, which is owned by Elon Musk of Tesla, was just approved to build a tunnel from Rancho Cucamonga's Metrolink station down to the Ontario Airport underground. And this is a project where the transportation entity involved in this was trying to figure out a way to do this, and their costs were coming in here, and the Boring Company came in and said, well, we can do it down here, and we can just dig a hole in the ground and build a 4-mile tunnel to shuttle people from the Metrolink station using electric vehicles straight to Ontario Airport. And I believe it's the county and they came in unsolicited and said, we're aware of what you guys are trying to do, and we can do it a hell of a lot cheaper, I think at like a tenth of the cost. And the county, to their credit, actually listened and said, tell us more, and now the project's approved. And just a couple short years later. A lot of residential going in. The largest is really down in South Ontario and South Chino, where the Lewis Group of companies is really driving a ton of new residential growth, which is coming with schools and shopping centers. About 120,000 homes that are planned down there. But you also have smaller pockets. Calamasa, about 1,000 acres of land was just sold, where about 3,200 homes are planned. Lewis is also working on a project in Rancho Cucamonga where they're converting the old Empire Lakes Golf Course into about 26 to 3,400 homes on 160 acres. And that's going to be more high density, much more akin to something you'd see in the eastern San Gabriel Valley or even certain parts of LA. And then the last thing I'll share is Village Partners, which is a group that's really more known for mixed-use urban projects in LA and Orange County, is building a mixed-use project in Montclair, just north of the mall, but adjacent to the Metrolink, and soon to be Gold Line extension, which will extend from LA County into San Bernardino County for the first time, and eventually potentially to the airport. They just proposed a similar project in Redlands, where I live, to tear down the old Redlands Mall and build this beautiful Mediterranean European style mixed use project with about 740 units. And so we're starting to see these more Orange County-esque projects coming our way, and which is clearly a reaction to the massive shift of millennials that are coming east now, which I'll self-describe myself as an elder millennial. Anecdotally, I can see it happening. It's starting to occur here, which is just upside.
That's awesome. That's great. Thank you, Greg. And Susan, I know you wanted to talk briefly about an area of the high density, but let's let Maggie go first, and then I'll go to you, Susan, and we'll wrap up.
Well, compared to that list of what's going on in the Inland Empire in that area, there's not a whole lot going on here in the Coachella Valley. I don't see that much changing infrastructure-wise. Like I said, we do have a lot of new residents moving in. Those are full-time residents. They are much younger. We've seen a renaissance, obviously, of Palm Springs. Now known for their modernism, architecture. And I think that Palm Springs really benefited from the halo effect of all the people that came in for Coachella and Stagecoach. Like 20 years ago, you would never see a bachelorette party going on in Palm Springs. And now you see them everywhere you go. So I think that it's just been discovered by a whole new generation of people, and they're enjoying that. And we have, obviously restaurants and other businesses coming in to feed off of that. The Agua Caliente Indians did build and open their third casino at Highway 111 and Dave Palm Drive in Cathedral City. I think the other big infrastructure project is the hockey arena for 11,000 seats, as I mentioned. And I think that there's been one area that people maybe didn't realize was growing so densely residential wise is really north of Indio, north of the freeway at I-10 and Monroe and Jackson, where we now have, I don't know, probably 1.5 million or a couple million square feet of retail with much more to come, and many fast food restaurants we have in the works. One of the top golf type places is taking a look at our project with Walmart. And so we have lots of things coming our way in North Indio.
That's great. Thanks, Maggie. Susan.
Yeah, and Greg, I totally agree. We didn't mention it on this call, but the work from home millennial, that trend is only going to propel, I think, the Inland Empire growth, where people can buy the house and still have the LA and OC job. So I think it's here to stay, to your point. But yeah, I was just going to give a quick shout out to the city of Adelanto, who's doing a great job of being kind of a microcosm of what we've described here on this call with attracting the new businesses. The Boring Company bought some land up there. They've obviously embraced the cannabis world the last 8 to 10 years out there, and they're reaping the benefits of kind of the top-notch upper echelon, kind of cannabis operators and the money that's being invested up there. But there's a new mixed use project going in where they're going to rebuild the city hall and the city buildings and add medical and hotels and kind of bring a grocery anchored center to the area. And I just think that you wouldn't have been talking about Adelanto on a panel, 5 years ago. So I just thought it was worth mentioning that it's another high desert city kind of being put on the map because of these trends.
We might not have been talking about it on this panel unless you had jumped in and shared it. So thank you, Susan.
Yes.
Always good to get new knowledge. Some of the other questions that people had asked really related to anchor tenants, non-food tenants that are active. I think it'd be kind of fun to put together a list of some of those items. But I think that we covered most of the topics that people had asked about. I want to thank, it's straight up 12 noon. And I want to thank everybody for joining me on the panel. I want to thank all the people who attended. I hope you found this informative, and you scribbled a lot of notes of things that are happening out here that will affect future retail. And wish everybody continued success as we enter into our new economy. So thank you.
Thank you, everybody. Thank you, Brad, for putting this together.
Thank you, everyone.
Thanks, everybody.
Be well.
Thank you all.
Take care.